The internet has divided car buying into two loud camps. The first camp swears you should only pay in raw cash to avoid the evil grip of interest rates. The second camp tells you to finance the car at 5.5% and invest your extra cash in index funds to beat the system. Both of these strategies are mathematically broken. Let's do the math everyone else is skipping, because both sides completely ignore a hidden variable called the opportunity drag metric. To see how this works, let's look at two different people. Alex and Ben both are 32 years old, earn a solid $140,000 a year, and have exactly $60,000 sitting in cash. They are both buying the exact same $50,000 vehicle, but they take completely opposite paths. Alex plays it safe. He writes a single check for $50,000 because he hates debt. He drives off the lot owning the car completely free and clear. Ben takes a different route. He puts down $10,000 in cash and finances the remaining $40,000 at a 5.5% interest rate over 60 months. Ben leaves his other $40,000 in an S&P 500 index fund, confident he can easily outinvest the cost of his loan. On day one, both men feel like absolute winners. Alex feels secure with 0 monthly payments, while Ben feels like a financial genius who is beating the banks at their own game. But feelings and balance sheets are entirely separate things, and the next 3 years will completely change the physics of their money. For the first few months, it looks like both men made the perfect choice. Alex experiences instant psychological relief. When he wakes up every single month, he has 0 debt payments hanging over his head. He experiences the pure joy of absolute ownership. When he hangs out with his friends or talks to his family, he gets to brag about how he lives completely debt-free. He looks at his monthly budget and sees total freedom because nobody owns a piece of his income. To the regular world, Alex is living the ultimate financial dream. At the exact same time, Ben is enjoying his own sophisticated illusion. Every time he opens his brokerage app on his phone, he sees his $40,000 investment moving up and down with the stock market. He watches the daily gains and feels like a true financial genius. In his mind, he has pulled off a master move by using a leveraged play. He gets to drive a brand new car while keeping his large nest egg growing in the background. He convinces himself that only amateurs use cash, while the real pros use other people's money to get rich. Everything about this feels real, tangible, and smart, but the balance sheet hides a silent partner. As time moves into years 1 through 3, the simple math done on a napkin begins to crash into real-world friction. This is where the hidden traps for both men finally show up, changing how their money actually flows. Alex faces a major problem with his liquid savings. By writing that huge check on day one, he wiped out 83% of his emergency money buffer. He went from a very comfortable $60,000 down to just $10,000 in cash. Now, he feels unsafe. To rebuild his cash cushion back to where it was, Alex has to make a big sacrifice. For the next 3 years, he must aggressively stop putting money into his normal investments. Every extra dollar he earns cannot go toward building new wealth. Instead, it must be used just to refill his empty bank account. Ben faces a completely different trap that chokes his monthly budget. His $76,400 monthly car payment creates a heavy drag on his free cash flow. Every single month, that large chunk of money is automatically snatched out of his paycheck before he can use it to build his life. If Ben hits a brief professional gap, faces an unexpected job transition, or wants to take a lower-paying dream job, he cannot escape. That rigid debt liability remains exactly the same, forcing him to stay locked into his current income level just to feed the monthly car loan machine. This brings us to a major shift in the physics of money, something we can call the velocity crossover. Most financial advice treats all math the same, but a car is a completely different animal than a house or a stock. In reality, a car is like a melting ice cube. It loses roughly 15% of its total value every single year. When you mix normal investment math with a fast-melting asset, the standard rules of compounding completely fall apart. This reality hurts both men in ways they did not plan for. Look at Ben's situation. Because he chose to finance, he is now using compounding leverage against an asset that is actively decaying. Every month, Ben pays interest on a loan balance that is breaking away from what the car is actually worth. He is paying extra money to protect a shrinking asset. Meanwhile, Alex is not doing much better. Even though he has no debt, he has permanently locked up a massive amount of cash in an illiquid, declining liability. His $50,000 is stuck inside a machine that gets less valuable every time he turns the key. He can never easily get that cash back out to buy something that actually grows. Both men are letting the natural decay of the car dictate their financial strength. To understand why this happens, we have to look at the silent drag of hidden financial systems. Most people look at simple percentages on paper, but the real world operates in brutal raw dollar amounts. Let's look closely at Ben's plan. He thinks he is winning because his 8% stock market return is higher than his 5.5% car loan. But bank loans do not work that way. Auto loans are structured to front-load the interest. This means Ben is paying heavy interest charges on day one, when his loan balance is at its absolute highest. At the exact same time, the $40,000 he left in index funds is exposed to market volatility. If the stock market drops in the first year, his investments shrink while his heavy loan payments stay exactly the same. He isn't cleanly beating the system. He is taking a massive risk. Now look at Alex's true cost. He thought he saved money by avoiding interest, but his $50,000 cash lump sum represents something much worse. It is a massive extraction of seed capital. By pulling that cash out of his bank account, he took away money that can never compound for his retirement again. That $50,000 is gone forever, completely missing out on decades of growth. Both methods create a silent leak that drains their long-term wealth. When we project both paths out over 20 years, the math leads to a total stomach drop. Let's assume that both Alex and Ben continue their habits and buy a new car every 7 years for the next 2 decades. What started as a small choice at age 32 turns into a massive gap in their net worth by the time they turn 52. The raw dollar divergence is staggering. Alex has spent 20 years consistently draining his liquid seed capital to buy cars with cash. Because that money was pulled out of the market, he missed out on hundreds of thousands of dollars in compound growth. Meanwhile, Ben spent those same 20 years with his monthly cash flow completely choked out by permanent car liabilities. Because he always had a $76.4 monthly payment, he could never save extra money or invest aggressively during market downturns. Both paths dramatically stunted their wealth. This math creates a painful lifestyle divergence. One of them finds himself completely trapped, working a high-stress job he dislikes just to support a lifestyle filled with permanent cash flow leaks. He is stuck in a loop, trading his precious time for monthly payments on a driveway full of decaying metal. The other man, by avoiding both traps, allowed his money to compound quietly in the background. He achieved true portfolio escape velocity, meaning his investments now make more money than his living expenses. He has the ultimate freedom to quit his job, travel, or retire early, while the car buyer is still stuck on the financial treadmill. To be completely fair, we have to look at both sides of the coin. Math works perfectly on paper, but human behavior can easily ruin a good plan. For example, Ben's strategy of investing his extra cash to beat his car loan depends on one major thing: keeping his cool when things go wrong. If the stock market hits a bad patch and crashes, Ben might panic. If he watches his index funds losing value while his monthly car payments stay high, fear might take over. If he panics and sells his stocks at a loss just to cover his bills, his entire strategy completely collapses, leaving him with less money and a massive amount of debt. However, there is one rare scenario where financing a car actually beats paying in cash. Sometimes, car companies offer special promotional deals, like a 0.9% interest rate, just to sell more vehicles. If you can borrow money at less than 1%, the math completely changes. In that specific case, you do not even have to risk your money in the stock market. You can simply put your cash into a totally safe high-yield savings account or government bonds that pay a guaranteed 4 or 5%. When your safe savings account makes more money than your loan costs, you are winning a guaranteed victory. The problem isn't the car loan itself. The problem is choosing a path without mapping out the real risks. So, how do you avoid these traps before you step onto a car lot? You need a real system to test your options instead of just guessing. To do this, you must use a tool called the net capital drag formula. This formula teaches you to never look at a monthly car payment or a total cash price by itself. Looking at those numbers alone is a trap. Instead, you need to run 3 simple structural rules before you ever talk to a car salesman. The first rule is the cash buffer rule. This rule states that if paying cash for a car drops your liquid savings below a safe 6-month emergency level, you cannot afford to pay cash. It forces you to protect your peace of mind first. The second rule is the amortization to depreciation ratio. This rule compares how fast your car loan balance goes down against how fast the car loses its value. If your loan balance stays higher than the value of the melting ice cube car for the first 2 years, you are trapped in a bad deal. The third rule is the opportunity cost multiplier. This rule calculates exactly how much money that cash lump sum would make if it stayed inside the stock market for 20 years instead of buying a car. When you run these 3 rules together, they show you the cold truth. Trying to beat a 5 or 6% car loan by investing in the stock market requires an historical miracle. The market moves up and down too much in the short term to guarantee a win. Unless the car company offers you an interest rate that is practically zero, the math shows that both traditional paths have serious hidden costs. You must stop listening to loud online opinions and start calculating the real drag on your wealth. When you look at the big picture, you realize you do not have to choose between the loud internet arguments. You do not have to listen to the people who say you should never buy a new car, and you do not have to listen to the people who tell you to leverage every single dollar you own. There is a third way. It is a quiet, data-driven approach that ignores the noise and focuses only on what the numbers say for your specific life. It is about checking your own balance sheet, instead of following a generic rule made for millions of strangers online. Because calculating the exact front-loaded amortization against your specific market portfolio tracking is 2 different things, I built a tool inside the vault that does this exact auto-arbitrage math for you. You do not have to guess if you are making the right choice or spend hours staring at a complicated spreadsheet. You can just plug in your own numbers, see the real capital drag instantly, and make a smart decision with absolute confidence. The narrative on your screen is loud. The math is quiet. Pick which one dictates your future.